Well, again, good morning, good afternoon, wherever you're joining from to today's webinar to chat about what we're dubbing the retirement secret weapon, which is a market rate cash balance plan. So I'm Kate Pizzi. I'm a partner here at Fiducian Advisors, and I am joined by my colleague and fellow partner, Brian Carlson. So hi, Brian.
Good
Before
morning, afternoon.
Before we jump in, though, I think it's probably worthwhile just to kind of acknowledge what's going on in markets this morning. And, in light of the equity market sell-off that we're seeing as investors start to, I'll say, digest President Trump's tariff announcements yesterday afternoon, I want to encourage everyone that's joining us today to join us next Thursday as well, April 10th, for a discussion on capital markets and investments with our Chief Investment Officer, Brad Long. So that's next Thursday, the 10th. So let's jump in and kind of put our long-term investment caps back on as we think about retirement plans and particularly cash balance plans. So thank you for those who have submitted questions in advance. We'll certainly try to address those as we talk over the next 30 minutes. If you have additional questions, there's a chat box in this webinar, so enter those through the chat. Again, we only have 30 minutes, so we'll do the best we can to get to all those questions, but if we don't get to your question, we'll follow up directly. So we'll jump in. Brian, let's start perhaps with a bit of a history lesson. So just a couple minutes here. In 2006, it was really a milestone for cash balance plans generally with the passage of PPA, or the Pension Protection Act, which really allowed for much more clear legal guidance or protections for plan sponsors who are thinking about adopting cash balance plans. So backing up, cash balance plans are technically a type of a defined benefit plan, a qualified defined benefit plan under ERISA, but they behave quite differently from traditional pensions and act much more like a 401k. So Brian, maybe you can kind of expand on that a bit.
Sure. Thanks, Kate. And kind of speaks to the level of interest maybe in defined benefit plans. But I know both you and I are very enthralled and intrigued about the landscape for 20 years, and we're still calling it a secret, right? But yeah, traditional pension plans and cash balance plans have been around for a long time. We'll talk about how some of the cash balance plan has evolved over the last decade plus or so. But really, in the essence, these are pension plans, the cash balance side of it. The formulas of how you derive benefits, that's where it tends to differ from some of the traditional side. So as these has evolved over the years, started with some fixed rate, and we'll get into some of the crediting rates and treasury rates. But again, they're basically providing a bridge, if you look at them and try to simplify, between what a 401k does and what a traditional pension does. So these cash balance pension plans have account balances, and those account balances have what I'll call pay credits every year. So you're getting kind of a contribution type credit every year, and that's how part of the way your balance is growing as an individual. But then also there's that investment or that interest crediting rate side that's also helped growing that balance. So that's where they differ a little bit, whereas a traditional pension, say maybe is based more on average pay of like the last 5 years. A lot of, as an organization, how you carry those liabilities on your books is subject to interest rate volatility. These are more 401k-like in that they're balances that are growing every year, either on contributions or on the investment side.
Yeah, and then in 2014 there were some changes to the regulatory landscape that kind of paved the way for what's called market-based cash balance plans, and that's really where we're seeing a lot of growth, a lot of opportunities, and that's really focusing in on that interest crediting piece, in which instead of having a fixed 5% or something tied to treasuries, it's really tied to the earnings on the investment portfolio. And that's really been kind of the game changer, at least in our eyes, of what has made this now into this secret weapon and fixing a lot of the shortfalls from kind of first generation cash balance plans.
Yeah, that's right. Like the previous versions, we'll call them, right, with, as you mentioned, the fixed rate or a treasury rate. they kind of reduce some of the volatility still to a traditional pension. If you're an organization carrying it on your balance sheet, or you're looking at the liabilities that you might have to pay somebody into the future. So they were reducing that along the way. And then market rates from an organizational perspective continues to reduce it even further, right? So those other designs that you mentioned, your balance was growing by, if it's a fixed rate, let's say 5% per year. So you're getting your contribution credit, plus then that balance is growing by 5% every year. So as an organization, if you're carrying that on your books, though, for multiple hundreds or thousands of employees, you still have to invest those dollars, right? And so as you're seeing today, as you alluded to, the market has volatility. So investing those is going to differ from a 5% fixed rate. So you had potential over and under funding that would happen. Similarly with treasury rates, right? Treasury sitting at, call it 4% today. So you're crediting people, or their investment balances or account balances are growing by 4%, but you're investing those, and you're getting something that's different potentially from treasuries on an annual basis. The market rate, what that did, it says whatever your assets earn, with some caveats, but whatever your assets earn are what those account balances are going to grow by. So that just continued to further reduce some of the volatility of putting those benefits out there and then having to put dollars behind those to invest those in liquid securities like stocks and bonds. There is some provisions, right? There's a capital preservation floor. So the amount that you put into the plan, or the amount that you credit to an individual over their lifetime, can't go below what that contribution is. But if you look at over the lifetime, we'll talk about how these are invested. You can kind of reduce some of that volatility as well. You can't avoid it entirely, but you just have to know going in that the amount you're going to put in per employee, you can never give them or pay them out a benefit that's less than that capital preservation. But their balances are going to change now by, if the market's up 3%, balances grow by 3, it's up 8, they grow by 8. If it's down 10, that's where that capital preservation floor potentially comes in. So
Yeah,
yeah, it's been a pretty big change and shifted a lot of people's willingness to put these into effect.
yeah, I think it's probably worth noting, right, that that floor is on a cumulative basis. So even if in any one year you have a real large drawdown, market drawdown, it may not actually tip into that capital preservation floor, which is an important piece, and actually something that we'll talk about when we get to the investment side. So something that we look at really closely when it comes to investments. So let's spend a couple of minutes talking about the type of organizations that we see using this market-based market rate cash balance plan, and also some of kind of the evolution on how to view these going forward.
Sure. Yeah. And there's some stats out in the marketplace. Some of them are a bit dated, or probably not as complete as they would look at the surface, but there's something like 20,000 plus cash balance plans out in the marketplace. Now, many of them are for small kind of single sole proprietor organizations, or kind of ownership structures. The ones that we're typically talking about or getting involved with, I would put them into two camps almost. One is kind of like professional service firms. So think law firms, think doctor practices, partnerships. Typically, these are organized under. A lot of those entities are using these more for high income earners and the ability to tax defer more income. And then I would say, and we'll get back to kind of some of the nuances of each, but then I would say there's also a camp that's more what I would call your traditional corporation. Like IBM just kind of reinstituted or reopened their pension plan with a market rate cash balance formula. So they can go all the way up to mega size organizations. But many of those other organizations where they don't have such a disparity of high income earners versus staff, let's call it, they can be using these to more spread across kind of a full holistic retirement plan approach, right? You can give a benefit through a 401k still. You can complement that with a little bit of a cash balance formula. And so you kind of have your stability with cash balance. And then you have your 401k, which is supplementary. So they work together nicely. So I would say that's kind of broad organizations, but really the professional services where they're really looking at is the ability to unlock some of that tax deferred income, right? If you think about 401k profit sharing, you're ballparkish, depending on age, about $70,000 of being able to tax defer income. If you start to put these cash balance plans into place, you start to get upwards north of 100 to 200 to 300 plus thousands of additional tax deferred income that you can put into a qualified plan by introducing a cash balance formula.
Yeah, and I think it's good to underscore, right? These type of plans can be effective for very large organizations too. So I think that's a good point to underscore. But there are pieces of the cash balance plan that don't act like 401k plans, that really are that defined benefit requirement, and that has to do with some of the inflexibility of the contribution piece. So while there's a lot of flexibility in plan design, there's kind of one key aspect that keeps it in that realm of defined benefit side, and that's with contribution. So maybe we can dig in there a little deeper to help our attendees kind of appreciate that nuance.
Yeah, so went a little bit on the kind of contribution side from an individual perspective, right? But because these are pension plans, right, there's not a lot of flexibility or variability to like a 401k. You can take your deferral up to 10%, you can take it down to 2, you can go at 5, you can go at 0, right? This is more of a defined benefit plan. So you're in essence, there is some flexibility, but basically you should think about this if you're putting it in place that you're locking in that contribution on an annual basis as an organization or as individuals if you're really small sole proprietors that are trying to establish these plans. So that's an element that's I wouldn't say it's, to your point, necessarily a drawback, right? But it's just something to know going in that if you've committed to putting a plan in place, the contribution side is going to be a constant on a year-by-year basis. Some of the other sides on the contribution that we didn't hit on yet are, kind of your ability to unlock this secret, so to speak. So mentioned that they typically go alongside a 401k and a profit-sharing plan. Many of the organizations that have been attracted to these plans are already making big profit-sharing contributions to that 401k side. Because even if you put this plan in place and you want to unlock the full maximum table of contributions, you still have to pass testing, right? So you can't just say, okay, I've got these executives over here that I'm going to give this great cash balance benefit, and I'm not going to do anything for everybody else. You still have to make sure you're passing some of your testing requirements. So that's another element, kind of similar-ish to kind of a DB and 401k construct to be aware of as you're putting these plans into place.
Yeah, and then you kind of just going back a little bit and addressing one of the questions that we received as far as the type of organizations or the corporate structure that can take advantage of these plans. And it really, it can be applicable to any corporate structure, whether it's an S Corp, a C Corp, obviously an LLC. But there are many ways to be able to structure the cash balance plan in its flexibility to be able to address really what the key goals of the retirement program look like. And being able to, even though the contribution piece is more of that fixed piece of the defined benefits side, you can structure that in a formula which really addresses some of the concerns from a corporate perspective, from the goals and those objectives.
Yeah, for sure. Much like a traditional pension, if you're a corporation, right, your contribution is lowering your taxable income, right, as an entity. Out a partnership, it's almost kind of like the flow through, right? It's potentially lowering the taxable income by individual, depending on how your partnership is structured. So yeah, it's a great point, Kate. I mean, it's a lot of times they get used more for partnership type arrangements, which they're great for those, but it's not exclusive to partnership organized structures for sure.
Yeah. And one of the benefits, and a question that we just got that I want to address, of it being in the defined benefit structure is that you have the protections of the PBGC still for this plan. 401k plans don't have those protections on that Pension Benefit Guaranty Corporation, kind of the insurance program that backstops the defined benefit plans. That is also available in the cash balance space. So a question that came up that I think I wanted a good opportunity to discuss. That also leads to the contribution side, maximum contributions. We talked about the deferral ability here, but that is really pretty large. I think you addressed about upwards of $300,000 per year, but cumulative, that ability to save is upwards of 3.5 million on a cumulative basis per individual, and that's determined by what's called a 415 limitation. That's something that we do take into account in the investment strategies as well. So maybe we can talk a little bit about how those limitations impact how we think about investing.
Yeah. So yeah, correct, Kate. You got that lifetime limit of today. It's around $3.5 million. It grows and changes over time, but yeah, that's still a great kind of substantial piece of being able to save in these. Organizations to kind of unlock that full potential of contribution are probably needing to give a profit sharing contribution or some sort of kind of commensurate benefits from the contribution side to people that are not in the cash balance plan, or even that are, up to about, call it 5 to 8, 7.5%. You probably need to give a contribution out to all employees. So we've talked over time, Kate, about who's a good, attractive candidate as an organization. So if you're already doing a profit sharing at 5%, ballpark-ish, or maybe even more, you probably have the ability to unlock some cash balance, pretty significant savings in there. But yeah, the contribution side, and the growth of these, if you just think about, if you're contributing and getting up to the max, right, those individuals still have the benefit, it's just not growing, right? So there's other, call it plan design features that plans tend to implement, to either in-service withdrawals at like 59.5, so people can roll that lump sum out. Most of these benefits are typically paid as a lump sum, although by law you have to offer an annuity, but most take it as a lump sum. But yeah, there's some restrictions, but it offers up a lot of flexibility and opportunities to tax defer more income, or build a more holistic, if you're paternalistic, trying to build a more holistic kind of benefit package for your employees.
Yeah, and on that latter note, right, because it's a defined benefit plan, as you mentioned, it has to offer the option of an annuity. So for perhaps a corporation that is looking to use a cash balance plan as part of a holistic retirement program, a cash balance plan can actually kind of solve the in-plan annuity issue that's plaguing 401k plans at a much cheaper, kind of no cost, if you will, on the plan. So something that, again, I think is a real key consideration in holistic retirement plan programs.
Yep.
So let's turn our attention to those investment trends that we're seeing across our client base as we talk about potential ways to be able to kind of maximize those 415 savings and also meet the needs of individual participants in a plan that is invested at the plan sponsor side. So maybe we can start with risk pools.
Yeah. So one of the trends, as you mentioned, with the floor, a lot of these plans still invested pretty conservatively. So let's say 50 to 70% in fixed income, to make sure they weren't kind of breaching those capital preservation floors. More recently, kind of because of that, and I don't know if it's from feedback, but they're saying, in a 401k, you can invest 100% equities and you have unlimited upside and downside, I guess, as well. But how can we get more investment gains out of the plans? But how can we tailor it potentially more to individuals? So the risk pools have become a topic. I would say adoption is pretty low. Call it in the 5-ish%. From some of the statistics we see are adopting these multiple risk pools. And what these would be at the outset of the plan, when you also can kind of say how much you're going to contribute. If you're in a partnership, sometimes there's some flexibility there. You would then also elect, do I want to be in a conservative or a moderate or an aggressive pool? Now, you can't kind of start to breach the 401k kind of disqualifying levels. So the investment flexibility isn't there. You can't say, want to be aggressive this year, market's volatile this year, I want to get conservative, right? So it's kind of almost a one-way election. You can change, like your pools can change their risk appetite over time, but individuals can't go in and say, I want to select this one at this time or rebalance this way. But we are hearing a lot more about what are the advantages, what are the drawbacks of offering up the people that are going to be in this plan with multiple investment, call it paths or pools based on risk appetite.
Yeah, it is. Yeah, I think in this risk pool approach, it is moving more towards kind of that 401k type structure, right, in which you can tailor those investments a little bit more towards those individual needs. So, how about some other trends that we're seeing, and particularly kind of us as fiducian, those market shifts that we've been making?
Yeah, so I would say, as you alluded to, next Thursday we'll have some market information from our CIO. Kind of over the last couple of years, we've been kind of trying to be a little bit more cautiously optimistic, I would say, about certain asset classes. We had shifted maybe throughout last year a little bit more conservatively as the market was moving up, maybe starting to see some of the fruits of those labors this year. I would say in general, though, talking about risk appetite of the end investor, call it the end entity that's using these cash balance plans, been a little bit of a shift. As I mentioned earlier, most of them at the outset were pretty concerned about that capital preservation floor. Today and days like this may change some of that philosophy, but leading up to last year, over the last couple of years, a fair amount of clients and prospects have been talking about, should I potentially increase some of the risk appetite here, right? They're kind of saying, okay, over the lifetime of this plan, markets ebb and flow, but there's a high probability they'll be positive. So breaching the floors, maybe not as big of a risk as I thought. Also, I've got this 415 limit. Some people are getting to that, but not everyone. So should I take on some more investment risk to potentially try to increase the more people to get up closer to that 415 limit versus being super conservative and focused on the downside, shifting more towards upside. I would say it's not massive though, right? You're talking about moves to maybe a 60-40 mix, maybe a little bit beyond that of 60 equities, 40 bonds. So it's not a massive shift to like 80 or 90%. They're not definitely going with the endowment model where it's a lot of illiquids and privates and heavy equity and low bonds from that perspective.
Right, and on that note, particularly around illiquids, right? With the cash balance plan, you have to be very careful on your investments in private markets, illiquid investments, in which recognizing that these plans have the ability to pay out as lump sums, right? That is one of the key features here. So I'd say from our perspective, right, tread lightly when it comes to investing in illiquids. However, marketable alternatives, hedge funds are an area that for larger plans, it actually may make some sense.
Yeah, for sure. I mean, especially as the plan grows, right? And you've achieved a certain level of good growth. Maybe some people are at the max and not contributing anymore. Managing that volatility, marketable alternatives can help provide a diversifying or more uncorrelated asset investment compared to long-only stocks and long-only bonds. I think that there was a question about some of the volatility of these plans to segue back to traditional plans and like PBGC coverage. I haven't heard anything about removing some of the PBGC coverage or premiums or lowering those. I guess the softening of that as you get is you still have your kind of hard dollar PBGC premium, but because the volatility of funded status is expected to be lower in these plans, your variable rate premium, either isn't as high or isn't as probable within these types of plans. But I don't know if you've heard anything different. I haven't heard anything talk about administratively removing or changing PBGC coverage on cash balance pension plans specifically.
Yeah, I have not either, and I'm hard pressed to think that would be something that they would be thinking about seriously, because of that difference between what you've just said, that kind of that fixed per head, which tends to be rather low comparable to the variable piece of that premium, which for many market rate cash balance plans is zero.
Yep.
So
Correct.
yeah. Another question that we had received kind of goes back to some of the design features and what's considered cross-testing. We only just mentioned it briefly, non-discrimination testing, which is an incredibly important part of plan design and really underscores the importance of working with experts in this area to make sure the plan structure is not going to trip any non-discrimination kind of rules that are in place. But cross-testing, you can test these alongside the 401k to ensure that it's fair across all pay scales. Again, there's a lot of details on plan design to ensure that's the case, and to be able to kind of unlock those benefits to your highest pay while still meeting the requirements to make sure you are not discriminating against non-highly compensated employees. Anything kind of more to add to that, Brian?
I guess the only thing is there is some flexibility, right? But you still have to meet those guidelines. Some of the things we've seen other clients do is, maybe they went into this only looking at highly comped or some of their partner or owner group, but they brought everyone else in because it was easier to pass testing and give a benefit. Some have added, I would say, certain elements or certain levels of employee to this so they can help to pass testing. So maybe you start to bring in more of your C-suite or managing partners, not just benefiting from this, but people kind of further down the comp. But there is, kind of like a 50 people. There's still requirements out there. There are flexible ways to construct your plan to make sure you can still do it. To Kate's point, you might just not be able to do it to the degree that the maximum tables allow based on some of the testing requirements that you might have.
A couple of other questions I just wanted to address briefly. Talking about, we got one question that was asking about a company's really inability to contribute both to a 401k and to a cash balance plan. Kind of what options are there? And I would just say that, this is, it's not an either or even an on top of. You kind of can look at the defined contribution, the 401k plan, and the cash balance plan together as a retirement solution rather than looking at these plans separately. Because I think a lot of times the affordability may be actually greater than you think, and you may have more flexibility by potentially even redirecting some of the contributions you have into a 401k plan into a cash balance plan. The other question that came up was, talking about just the cost of administration. So this is a defined benefit plan. It does require an actuary to do an annual evaluation and annual filings as well. So you're not going to really avoid those additional costs of administering the plan, but there are some pieces on, again, the plan design side that are impacted by the investments where you can help cover those expenses. So, Brian, have you seen much kind of in that side?
Yeah, I mean, I guess one element of it is, there's a cost to just fund these, right? So, depending on, Kate, as you alluded to, your setup of 401k contributions, profit sharing, and how much you want to do cash balance, your contributions to qualified plans might go up. So you could consider that a cost. You do, as you said, PBGC premiums, you have actuaries, you have potentially investments and investment advisors. So cost to administer, payroll, TPA kind of connectivity that exists. What some of the things we've seen is as plans are starting out because they're kind of starting with zero balance. They may just pay those costs from, call it, corporate assets. Eventually, much like other pension plans, you can run those costs through the plan, but to not have those be so burdensome in the early years, some have paid it outside of the plan. But I guess that's not really a cost reduction. It's just more of a cost shift. But yeah, going out to the market, like anywhere with your vendors, making sure that you're getting the great expertise at a cost-effective kind of level, is something we would absolutely suggest.
Yeah, and there's other design features with caps or et cetera that you can think about, but again, that really requires that upfront work with those experts to figure out what's best for you. So we've touched on a lot today, and there's so much more here to unpack, even some other, I'll say other offerings alongside a cash balance plan like partner-owned life insurance or non-qualified plans, but we'll keep it for another session. From history of cash balance plans to design trends and investment strategies. Hopefully, we've packaged a lot up for you in a short amount of time. But we understand that there's a lot of nuances in structuring an investment program that really supports those nuances in cash balance plans is really critically important to be able to deliver on your long-term objectives. So whether you're curious if a cash balance plan might fit for your organization, or you already have one and want to learn more either about investments or other areas of plan designs, please don't hesitate to reach out. And a reminder, join us next Thursday for our market review webcast. So on behalf of myself and Brian, thanks so much for joining. We hope this was beneficial, and we look forward to connecting soon.
Thanks, Kate. Thanks, everyone. Have a great day.